Growth or dividends. One can create generational wealth, whilst the other provides steady, passive income. For investors below the age of 30, I think there is a clear winner, growth, especially if you can stomach the volatility. So in this video, I'm putting growth and dividends head to head to show you exactly where you should be investing your money for long-term growth. So I am the Brummy Bull investor, and I want to show that financial freedom can be achieved by investing on a normal wage. If you don't want to miss out on any future videos, hit the subscribe button, and with all that being said, let's get into the video. So before we get into the video, let's quickly break down what growth is and what are dividends. So growth investing is simply high capital appreciation as the company is focusing more on growth by reinvesting everything back into the company. For dividend investing, you're rewarded for holding a company as you receive a small payment back. This is as a dividend. One focuses more on growth, which potentially means more money in a given time, whereas the other is more steady and focuses on slowly increasing. This is a bit like the tortoise and the hare, but the winner is you depending on where you hold and where you sell. Is it for a quick flip or for a long-term trade? So growth investing. Growth companies reinvest their free cash back into the company for high capital appreciation. So put simply, these growth companies, like the majority of the Mag 7 companies, are investing their spare cash back into the company instead of paying it out. This is so they can achieve higher growth. Investors invest in these companies like Nvidia and Google for the growth potential and return share price instead of getting a fraction in dividends. However, a trade-off is that these companies are a lot more volatile, so this needs to be taken into account as you have to be able to stomach these large rises and falls. I personally think the ages up to around 30 should be focused on growth, as you should be prioritizing accumulation of shares and value rather than individual income. But by income, I mean dividend passive income, not income from a salary, as you want to always aim for the highest salary to build your net worth further. For growth investing, it's important to understand that a lot of it depends on your risk appetite, how much you are willing to stomach, and then how long you can tolerate it for. Sometimes after doing your research, you might have to hold on for 2+ years as you truly believe in the potential. So it's important to build a strong foundation before buying in and to stick to your plan unless you have a genuine reason to change and to sell. So don't let your emotions take over. Another important thing is a value trap, which links to conviction, as if you see a company trading at a low PE but it keeps dropping, this will be known as a falling knife, and you want to ensure that you're in the right company or sector. A low PE might normally be warranted for a company trading below its historical average. You want to be looking out at the price to earnings to growth metric. This is another key metric to see if the extreme PE is actually justified. For example, Palantir trades at 200, but they have a strong growth rate, so it is justified. So here we have dividend investing. I personally believe that dividend investing is better suited for older people, maybe in the range of 30+ years of age. This is because you would typically have more priorities in life at this point, things like your bills, looking after family, and any other costs. The benefit of dividends is that you're theoretically getting paid as you sleep, as you're being rewarded for being a shareholder getting paid from these companies. So who wouldn't want free money? But the thing is, it typically comes at the cost of growth. So yes, it is less volatile, but there's less chance of greater returns. Normally, you want a dividend-paying company which is fundamentally strong. Examples of this are dividend kings like Coca-Cola or Johnson & Johnson. They have a nice dividend yield and have 50+ years of annual dividend increases. A problem to look out for is to not chase the dividend yield. A 15% yield may seem tempting, and this will be equal to £15 for every £100 you own in stock. However, this will likely be a dividend trap, as the company is likely in trouble, as a decrease in stock price will inflate the yield, so a £15 payment isn't useful when your £100 stock halves. So to solve this, a key metric to look out for is the payout ratio. So we can now compare dividends to growth. So a key metric here is compounding or compound growth. So compound growth is basically interest earning interest. It is essentially like a snowball, and as you roll it in, the snowball gets bigger each time, hence why it's also known as the snowball effect. And this links us nicely to the famous rule by the legendary investor Charlie Munger, who emphasized that reaching that first £100,000 portfolio should be your number one priority, as from here compound interest will kick in and the next 100 will be even faster, and this will compound over time, getting you to £1 million. I'm going to now compare two companies, Nvidia, which doesn't really need an introduction, and then Pfizer, which is a healthcare company. Now this is a complete comparison between pure growth and dividends. Looking at the graphs for the last 5 years, Nvidia is up around 1300%, whereas Pfizer is down 22%. If you had caught Nvidia at that price, you would have had decent returns, whereas Pfizer would have paid out steady dividends, which isn't the worst thing in the world. But this shows a difference in dividends and growth, and why for a younger investor, growth may be more rewarding. As we get older, we want to be looking for that dividend income, as passive income is more useful with time, especially with the fact that dividends in reinvested would grow further with this snowball effect. So let's say we have a portfolio value of £100,000 with a dividend yield of 5%. This will return us £5,000 a year, assuming the stock stays flat. Now, if you put that same amount into the S&P 500, which typically returns 7 to 8% when adjusted for inflation, and with dividends being reinvested, it will be worth £200,000 in 10 years, which is decent growth and fairly achievable middle ground. But it is possible to beat the market. Now, let's say you did your research and put your money into a well-researched growth company and achieved an average return of 20% over 10 years. This could be worth over £600,000 in the same period. Now, on the extreme end, let's say you bought into Nvidia 10 years ago, it would be worth £3.5 million in total today. So this shows the clear difference in compound growth. All you have to do is let it play out, but this can be risky. You have to have conviction into what you're buying into. So typical dividend paying companies don't beat the historic returns of the market, but there are some examples like BP, which is up 13% in the last year, and they also have a 5% yield. However, this is quite rare. Typically in market downturn with uncertainty like the recent Iran war, investors shift from high beta growth into more cyclical companies that pay dividends like Verizon or Costco. We've compared dividends to growth, but I think the best middle ground and the best option is dividend growth. This is simply growth companies which pay out a lower dividend, but they are growing this fast over time. Looking at the chart of Visa, it is clear they have outperformed the market various times, and you might see the dividend yield at 0.8%. I think this is quite low. However, if you bought £1,000 worth of Visa when they first started paying dividends back in 2008, you'd be getting £597 in dividends a year. This is equal to a 2,400% increase in payouts from purely them growing their dividend over time, and this relates to the yield on cost. The current dividend yield is 0.8%, but buying in 2008 would warrant an equivalent 11% yield on cost. Yield on cost is a relation between current dividend and your original purchase price. Another type of company we can look at are the ones that are trading at historical lows. For example, Google last year. People had forgotten about them, saying that search was dead. From the 2025 lows, they are up nearly 130%. Another example is ASML. It seemed to be forgotten as people didn't realize the moat they have with their lithography machines. But since then, it has returned a decent amount as the world can't live without these machines. These are examples of growth companies which are forgotten about. But we can also have companies that are trading at historical lows due to broader market news, like how the tariffs have affected Nike. I'm currently holding on, hoping for some appreciation going into the World Cup, and this is the same for Novo Nordisk, which I feel has taken a large beating, probably too far, and as we can see is at historical lows, while still trading at an appealing PE, and with the obesity market expected to grow with a compounded annual growth rate of 20%. I don't mind waiting and collecting these dividends in the meantime, as these trades can last from 1 to 5 years and not necessarily always have to be a long-term hold. So dividend growth can be growth companies with a low yield which are both growing over time, or it can be a beaten down, strong fundamental company with a higher yield, but a larger runway for growth. This all depends on if you have made the right call. And this leads us nicely on to my personal strategy. So being a 20-year-old apprentice, I feel I have time on my side and I can stomach more risk. So I'm more focused on growth companies. However, as mentioned, I do hold some dividend payers too, which I plan to hold for a couple of years, and this will chop and change over time. Yes, it feels rewarding receiving these dividends, but a larger majority of my portfolio is in growth. Another key thing for me, and I think everyone should do, is own the S&P 500. I aim to beat the market every year, and last year I finished around 30%. But I do also want direct exposure with my portfolio sitting about 20% in the S&P. So I've compared dividends to growth, but the key takeaway should just be to get started. There is a reason why people say the best time to start was yesterday and the second best time is today. A simple way to get started is to set up a recurring buy into the S&P and go from there. Remember, time in the market will always beat time in the market, so stay consistent, stay focused, and you will thank yourself in the future. So thank you for watching the video. Remember to like, subscribe, and leave a comment below as it really helps out the channel. I'm documenting my whole investing journey here on YouTube, so stay tuned for future uploads.